Hey traders, welcome to our webinar where we introduce a trading strategy that allows you to profit in both bull and bear markets, where you're not dependent on the overall market direction and when the overall impact of a stock market crash on your portfolio is significantly reduced. This trading strategy is called pair trading. My name is Mike Sir, and in today's webinar, we're going to introduce you to pair trading, explain to you how pair trading works, the benefits of pair trading, and how you can identify and profit from pair trading opportunities. More importantly, the team at GainTrade, with over 20 years of experience in statistical arbitrage and HFT, have developed cutting-edge software that helps you automate the entire pair trading process through an AI-powered bot and machine learning. Their AI-powered bot provides unique opportunities for automating and optimizing trading strategies, something that only hedge funds had access to due to the huge cost of analysis and collection of data. And this is their way of bringing institutional grade tools to everyone so you will be able to trade like the world's top hedge funds. So we're super excited to walk you through step by step on how the AI-powered bot works in helping you identify the best pairs to trade and automatically execute the pair trades for you. So let's get started. Let's begin by exploring the concept of pair trading. Now, pair trading is a unique trading strategy that aims to profit from the price relationship between two correlated securities, such as stocks, regardless of the overall market direction. This market-neutral approach involves simultaneously taking a long position on one stock and a short position on another stock to capitalize on the price differences between them. Now, the key principle is to identify pairs that historically move together, leveraging their correlation. For instance, the two companies Coca-Cola and PepsiCo are direct competitors to each other, and historically, their stock prices have generally moved together. However, sometimes due to temporary market inefficiencies, PepsiCo stock starts to outperform Coca-Cola stock for no apparent reason, so you as a pair trader would buy Coca-Cola stock while short PepsiCo stock with the idea that their price divergences would at some point return to their usual correlated state. Pair traders typically analyze the historical price movements of the chosen pair to identify deviations from their average price difference. Now, these deviations may arise due to temporary market fluctuations or external factors that make one company's stock stronger or weaker than the other. Fundamentally, the strategy relies on the assumption that certain pairs of stocks exhibit a correlation and will continue to move in a similar manner over time, now driven by their underlying fundamental relationship. Now, it's important to note that not all stocks can be paired together successfully. For instance, pairing Tesla stock with a biotech stock may not be suitable since there is no clear correlation between the two companies. As mentioned, the key benefit in pair trading is its market neutral strategy, meaning that you don't need to determine the overall market direction, you just need to focus on the price differences between the two stocks. This market neutral characteristic is particularly attractive during periods of market volatility or a stock market crash, and therefore another benefit of pair trading is risk mitigation. Now, for example, if the overall stock market falls, and if you are long one company stock and short another stock, the short position acts as a hedge and your risk is somewhat minimized. Lastly, pair trading allows you to exploit temporary price discrepancies or divergences between two correlated stocks. Now, these deviations can occur due to various factors such as market overreactions, sector-specific news, or company earnings or news. Now, pair traders seek to profit from these inefficiencies by identifying pairs with historically established relationships that are likely to revert back to their mean or converge over time. Now that you have an understanding of what pair trading is and how it works, let me show you how the GainTrade program and their AI-powered bot makes pair trading easy for you. So let us walk you through a simple 4-step process of how their program works, and later on we will show you a step-by-step demo of their leading-edge software. Now the first step is for you to choose an idea. Determine which pairs that you want to trade. Perhaps you want to look for opportunities in crude oil and look for price discrepancies between the crude oil ETFs and equities of companies involved in the oil and gas industry, such as oil exploration and production companies. Or you might want to exploit price discrepancies between common and preferred shares of certain company stocks. Or simply, you want to focus on statistical dependencies where you're looking for instruments such as equities, ETFs, or futures that generally have strong price correlations, and you look to exploit temporary deviations between them. The second step is to pick up instruments. Now, GainTrade has an AI-powered bot that helps you find suitable potential combinations for your pair trading idea on a daily basis. For example, here you can see that the AI bot has identified potential pair trading opportunities in the crude oil sector involving oil ETFs and oil equities. And it gives you the position size, the potential profit of the trade, and the side ratio, which is the ratio of each stock in the pair. Now I'll explain to you more of what these mean when we go through a demo of the program. As well, GainTrade utilizes their AI bot to help you find the best stock and ETF pairs to trade based on their historical correlations. The third step is to check for profitability. Once you run the program, the bot will automatically identify the prices where it will open trade positions for you along with stop loss and take profit orders. You will need to assess the profitability of the pair trade and ensure that the deviations are substantial enough to cover your transaction costs and occur frequently enough. In addition, GainTrade has a built-in commission calculator to help you assess the profitability of each trade. In addition, the program allows you to set specific size deviations from the mean to open a trade position and to take profit. Now, the greater the deviation, which is the difference between a trade's opening and closing levels, the higher your potential profit. But this will also mean less frequent trades. So this is where you need to find a balance between profit and the frequency of the trades. The fourth and last step is to automate your trading. Now, once the program identifies all the price levels for an open position, take profit, and the stop loss, the bot will automatically execute the orders for you. Most importantly, GainTrade has implemented several levels of protection to minimize your risk. So for example, after each losing trade, the bot will stop automatically. Also, GainTrade automates the pair trading order execution flawlessly for you, buying the first instrument and short selling the second. One way for you to manage risk is to build a balanced portfolio of bots using different pair combinations or different position sizing. Now, the program will warn you if you use the same stock or combination more than once. Also, it will alert you of upcoming corporate events such as company earnings announcements to avoid sharp spread movements. Let's now set up a paper trading account and we'll walk you through how the program and bots work. Once you set up and logged in, go to the bot builder. This is where you're going to build your pair trading bot. Now, the first thing that you want to do is determine what pair category that you want to focus on. Now, here you can see that you can choose from 6 different categories. You can choose to trade a specific stocks correlation versus the Dow Jones Industrial Average ETF. Or you can trade the correlations between a gold ETF versus a gold stock. Or you can choose from a wide range of stocks from different sectors to trade, or you can trade a specific stocks correlation versus the S&P 500 index ETF. Also, you can choose to filter by stocks from various industries, or lastly, you can trade the correlations between two different oil stocks or the oil stock versus the oil ETF. Now let's choose the crude oil ETF and equity pair. Now here you can see that the program has chosen various pair combinations for you. Let me explain to you what each column means. Now here you have the lot size. This is the total value of two pairs per one lot. The column SD stands for standard deviation, which is a measure of the amount of variation or dispersion of the pair's prices or spread from its mean or average. So basically, this gives you insights into the volatility or price fluctuations in the pair's spread. Now, for example, a low standard deviation would indicate that the spread's value tends to be close to the mean or the average, indicating not a lot of price fluctuations within the pair. Now, a high standard deviation would indicate that the spread is spread out over a wider range, indicating more volatility within the pair. Now, there's one huge benefit of the GainTrade program, as it allows you to select pair trading strategies based on their standard deviation. And this saves you a lot of time, and that's why you can trade as a hedge fund without the staff. The next column is the standard deviation divided by the lot size. Now this figure tells us the probable percentage of profit per trade per capital invested. Now obviously, the higher this percentage, the better. The last column is side ratio. Now this is the ratio of the price value of the first stock divided by the price value of the second stock in the pair trade. Now, if you want as little risk as possible, you want to look for a value closest to 1 since it gives you equal weighting to each stock. However, if you choose a higher value, then the weighting of the first stock is higher, and hence the price movements of the first stock have a greater impact on the trade. Now, this probability is calculated by the AI bot. Once you've selected the pair that you want to trade, the program will then determine the trader parameters for the pair. Here you can see that it has been determined that in this pair combination, it will buy 10 shares of the first asset, which is OIH, the Oil Services ETF, at $320.63, and short 279 shares of the second asset, which is NEX, the Next Tier Oil Field Solutions, at $10.27. Now, it has a pair lot size of $6,071.63, which is the total value of the pair trade per lot. Also, it displays the updated side ratio, which is 1.12. Now, here you can select the number of lots of the pair trade that you want to trade, and based on the number of lots, it will also calculate your total position size of your trade. Next, you can select the algorithm type. Now, generally, most pair traders look for a pair that has diverged, and therefore they look for the pair to revert back to its correlated mean. Now, in this scenario, you would select return to average, and you would look on the chart for the spread to be high or low enough and close the position when it returns to its average. However, there are cases where, due to corporate events, pair traders forecast the divergence of a pair, which is normally correlated, and they look to profit when the divergence happens. Now, in this scenario, you would select outside, and you would look on the chart for the spread to start trending up or down and close the position when it reverses. The next thing that you see here is the zero spread level. Now, before we discuss how to use this, we want to let you know that finding correlations between two stocks is not always sufficient. You want to understand the allocation proportions for each stock in each pair, and this is where the zero spread level can help adjust the values so that the chart can show when the two stocks are equal, so precisely at 0. In other words, we can observe that the current correlation is 0, indicating that they are currently moving in the same direction. So when you trade, you want to see the pair deviate from 0. Now, if you click on the tune levels, the program allows you to manually set levels based on chart patterns or statistics. Now, in the next webinar, we will discuss the zero spread level in more detail and show you how to adjust these levels. Now, here is the stop loss levels that are calculated by the program, and you can see it depicted in a red line on the chart. Now, there are two open position levels which are calculated. The open position bottom tells you where the absolute spread is high enough for you to enter into a position. However, to mitigate risk, if the absolute spread is higher than the open position top level, there is a risk of a divergence, and therefore the bot will not open a position. Now you can see these two levels in blue on the chart. The take profit level is depicted on a green line on the chart. Now, even though all these values are determined by the program, you have the option to change the parameters based on your risk tolerance. You also have the option to change these parameters right from the chart by dragging prices up or down. Based on the values that you've entered, you can see what the possible profit per position is if it hits the take profit level, as well as the possible loss per position if it hits the stop loss level. Now, if you refer to the chart, you have the options to change the time period on the chart, select the type of chart, as well as various technical indicators. And if you select Show Assets, you can view not only the chart of the spread, but also the price movements of the stocks itself. Lastly, below you can enter in the commissions charged by your broker, so the profit and losses are accounted for in your trade assessment. And also the program will display any upcoming events such as company earnings. Now that you have set up all the parameters for the bot, all you have to do is create the bot, and it will execute the trades for you. Let's look at some examples of pair trades that the AI bot has identified and executed for profits. Now here you can see a pair trade involving two correlated commodity stocks. You can see on the yellow chart here of the energy company Equinor, symbol EQNR, and on the turquoise chart here of the gold miners ETF, symbol GDX. Now both stock prices have been declining, but the most interesting part here is that Equinor has been falling much faster and is underperforming relative to the gold miners ETF. And you can see here the divergence as the spread widens to the downside. However, then the AI bot identifies an opportunity on June 2nd when Equinor's price starts to rise, where you can see the green arrow here, while the gold miners ETF doesn't, where we put a red arrow, and the price continues to fall. So you can see that the bot initiates a pair trade when the spread reaches the open position top. However, you can see here that the spread remains relatively choppy and the bot exits with a small profit. Now the bot continues to execute a few more trades with the Equinor stock continue to outperform the gold miners ETF. And this is a perfect example where you can generate a profit based on the pair's divergence and then its return to its mean. The next example that I want to show you involves two energy company stocks. Now you can see here the orange chart is Devon Energy, symbol DVN, and on the turquoise chart is Occidental Petroleum, symbol OXY. Now you can see that both stocks are trending lower, with the spread also widening to the downside. And this is due to the fact that Devon Energy is underperforming relative to Occidental Petroleum. However, on May 16th, the AI bot recognizes that Devon, with the green arrow here, starts to outperform Occidental, as shown with the red arrow. And this is where the spread reaches the open position bottom, where it initiates a pair trade.
Now both stock prices keep moving up until the bot recognizes that Devon, with the red arrow here, starts to underperform Occidental with the green arrow here. And therefore the bot closes the trade with a profit. Then the AI bot recognizes another trade on May 31st and opens up a new trade. And you see here on this chart that both stock prices are heading down until May 31st, when Devon's stock price goes sideways, as referenced by this green arrow here, while Occidental's stock price with the red arrow continues heading lower. Now at this point, the AI bot recognizes that Devon is outperforming Occidental and therefore initiates a trade. Then on June 2nd, Occidental's stock price starts to go up much higher, as referenced by the green arrow, relative to Devon's stock price, which is the red arrow, going steadily up. The AI bot recognizes this and exits the trade with a profit. Now we'll go through many more examples of these strategies, as well as new strategies in our next webinar. Thanks for watching this webinar, and we hope you learned a lot about pair trading. Now go ahead right now and open up a free paper trading account so you can test out all the strategies that we've covered. In our next webinar, we will go into some little tricks to improve the profitability of your pair trading. We'll see you all in the next webinar.